Hello, Anthony. How are you?
I'm great, Sebastian. How are you?
Excellent. Thanks for joining my channel and spending some time with my audience. We really appreciate it.
Absolutely not. I think I owe you the thanks. To be honest, I really appreciate you allowing for me to come on and chat with you a little bit, and I'm excited to talk with you to kind of, I guess, share what we do and hopefully can be of benefit to some of your people.
Awesome. Awesome. So, as mentioned, everyone, Anthony is a loan originator with First Savings Bank, specializing in the first position HELOC, which is why I'm so excited to, share this information with you and why I'm bringing him on here is to talk about this. So first, Anthony, if you could just give everyone a short background about yourself and then a
Sure.
little bit about First Savings Bank, and
Yep.
then we'll continue from there.
Yeah, absolutely. So I have kind of a diverse background. I played music for a little bit out of college, and then got my real estate license. And through that, met a real estate investor who allowed for me to hop on and sort of be the sweat equity guy for a real estate company that we had, and we ended up acquiring 40 units that I managed, right, for my share of the ownership. So did that, and then when I played with the band, I kind of before that had some questions about how my life work was actually helping people. Although it does, it was hard for me to recognize. So I left and actually I went into education, and I taught school for 7 years. I was a teacher. I did this program called Teach for America, which focuses on high outcomes, right, for high need schools, right. And so did that and loved that, and that sort of gave me the sense of gratification and purpose that I was sort of looking for at that time in my life. Met my wife through that, and we had kids, and we have twins and a 3-year-old. And when the twins got a little bit older, I had, obviously with education, the financial piece is it's not well known to be super great. So decided I want to provide for the family a little bit better. So I went into mortgage loan origination. And although that was great, and from a financial standpoint, it was very helpful for the family, I didn't quite get the gratification of knowing that my work day to day was helping change people's lives, right? Was helping improve people or helping people's outcomes. And that's, I guess, part of who I am as well. So here it comes along this first Lien Heloc product and strategy that isn't super well known here in the States. And what I learned about it was that the outcomes for this was so amazing, right? And because it's not well known, I feel like I get to still use some of my skill set from being a teacher. I get to help people, and I get to work in this sector that I've learned and learned about, and I don't know if expert's the right word, but I feel like I know it fairly well. So hopefully I'm able to do the work, right, that helps other people, supports my family, and also helps impact other people's lives in a really positive way. So that's kind of how I ended up here. I know it's kind of
Awesome.
a roundabout way.
Thanks for sharing that.
Yeah, absolutely. So that's my history, I guess.
Awesome. So tell us a little bit about First Savings Bank, please.
Yeah, absolutely. So First Savings Bank, it's a regional bank outside, out of Indiana. And it's a regional bank, so they've got a lot of stability in terms of future excuse me, in terms of history, right? They've been around for a good amount of time. They're publicly traded. We have retail locations throughout Indiana, and then a number of mortgage operations as well. We take a pretty high level approach to customer service, right? And for me personally, the culture within the bank is absolutely amazing. I haven't worked for too many bank institutions. I've heard that sometimes the culture within certain banking institutions can be not quite as positive, but I haven't found that at all here. All the way up to the CFO and the CEO of the bank. I hear stories of them, walking around and saying hello to everyone every day, right? I know that's more of a personal kind of thing, but to me, it's a testament to who I get to work for and who I get to work with. And, we do a number of, obviously we do the retail side of things, but also have a mortgage department as well. We focused a lot on the residential mortgage side of things, and entered in and started working and started introducing and offering to the marketplace first lien HELOC as well. And that's kind of where my function is here at the bank, is to help customers directly with that, but also to help grow the product here as well.
Awesome. Okay. So you're saying something that I know that most people have never heard about before. And so let's start at the bottom, kind of build up to, what this first lien HELOC is, right?
Yeah.
So first, I guess, talk to me and talk to the audience first about, what's a conventional mortgage, conventional HELOC? What does that look like? And then what is this first lien HELOC, first position HELOC all about?
Yeah, no, that's a good call. So the mortgage, as we know it, is a debt a debt tool, right? It's a tool that financial institutions use, right, to finance real estate purchases, right? So it's a loan that they give and it's secured by your real estate. Most mortgages function, or the payback structure that they have is through what's called an amortization schedule, and it's a set algorithm, a set math problem, right, that allows for you to have a fixed payment each month, right? Guarantees a certain payoff within a certain period of time, right? And that's what, I don't want to say pretty much everyone in the States, but I kind of feel that way. Most people by far use amortized mortgages, that loan structure, to help to finance their homes, right, and to help pay down debt. So that's your mortgage. A HELOC, or the way that people usually think about HELOC when they hear that term used, is it's an extension of credit, right? It's on top of your mortgage. So you keep your mortgage, in place, and what you do is the bank gives you access to the equity in your home, right, above what you owe on your mortgage, right? So they open up a line of credit, and usually the way that people use that is they borrow against it to add, to rehab their house, right? Or they consolidate debt, right? Right, and or they pay for their kids' college or buy a car, right? For one of those, different types of scenarios, you can really do anything that you want with the equity, and it's an open-ended line of credit, which is different than a mortgage. An open-ended line of credit means that you can borrow from it and you can pay it back, kind of like a credit card. A credit card is also an open-ended line of credit, right? Because money can go in and money can come out.
Right.
So when you open a second lien HELOC, the bank basically gives you access to borrow against your home's equity. The incentive for that is a couple of things, right? As compared to just using a credit card. One is if you have enough equity, you can have access to substantially more amount of money. And then secondly, you can do that at a lower interest rate because it's secured by your house. So usually that's the conventional way of thinking about a mortgage, right? And thinking about a HELOC. And so that's the general way. Our product is different than that, right? But that is the general way.
Before we dive into your product, because I know we're just about to get there.
Sorry, I'm itching. But
no, you're great. You're good. You're doing great. So, just for because everyone, my audience, everyone listening are in different levels.
Absolutely.
So let's clarify for folks. When we're talking about a regular standard mortgage amortized schedule, right? Right now the interest rates have gone up, and they're probably going to keep going up a little bit more. But in the past 10, 15 years, folks have been able to get interest rates as low as 1.5, 2, and 3%, right? And they're really adamant of sticking on those rates. But is that really what they're paying over a 30-year amortized schedule? What in the end, how much interest are they really paying?
That's a really good question.
Schedule.
It's a really good question, because I think that with the amortization schedule, right, and with an amortized loan, the way that people gauge or judge or decide whether those loans are good or bad, right, is by strictly looking at the interest rate. And it's fair to do that, because with that certain type of payback structure, the interest rate has a direct impact on your cost, right? And small changes in your interest rate, if you have a small increase in your rate with an amortized mortgage, it has a really big impact on your overall cost. And so with an amortized mortgage, it makes sense to focus on the interest rate, because that's how it happens. Now, in terms of your overall cost, if I have a 3% mortgage, 30-year fixed rate mortgage, that doesn't mean I just pay 3% of the overall balance of my loan, right? It means that every month I pay 3% 3% divided by 12, right? Because it's 3% per year. And if we divide by 12, and this is a rough way of explaining it in a way that hopefully people can connect with, right? Sure. Basically, give it like 3% divided by 12 against your balance, right, from the previous month. And so what that means is with that payback structure, and in terms of the overall cost that you pay, with an amortized mortgage, your payment it's a fixed payment each month, right? The payment is exactly the same each month. So part of your payment goes to interest, and whatever's left over goes to paying down your home. Well, if we think about, because it's a fixed payment each month, what that means is that at the beginning of your home loan, your balance is really high, therefore your interest payment is really high, right? Which also means that the ratio of your fixed payment, right, most of it goes toward interest because your balance is high. Well, if we think about what that does with your balance, that means it maintains a really high balance for a long period of time in comparison to other loans where you may be able to pay them down faster. But if you look at the graph, right, or the line graph of an amortization schedule, your balance stays high for a very long period of time. And what that means is that if you think about how interest rate affects that, you have, whether it's a low or a high interest rate, you have the interest rate that is being pinned against, or used against, a very high balance for a long time, right? Which means that you end up paying a lot of interest, and your balance doesn't get paid down very quickly. So that's sort of the way that I see it, which means that you don't just pay 3%, right? Right. Pay, there's a certain threshold, right, where I want to say it's 4.5, maybe 4.5, maybe 4.75. I don't know the exact number, but where you pay the exact amount of interest to the bank as they gave you, which means if there are different ways to think about that, but the way I think about that is you're buying a house for yourself and you're buying a house for the bank.
Wow.
Right. And that is a reality. And I think that people don't want to name that because it's a tough reality. And if they think that there's no other option, then it's just what you do. So we just don't talk about it. But that is a reality. And whether it's 1-to-1 or whether you're paying the bank back and giving them 80% of your initial principal, that's a lot of money to give back to the bank. And I think that's one thing that we don't name too often.
Understand. Okay.